So hi everyone, it's Wisdom Jordan right back here, and in this lesson, I want to be looking about the different types of trading or the different types of traders. Okay, so I want to thank those who have already given me a like on the videos I post, those who have subscribed to the channel, and please, if you're not yet subscribed to the channel, please do, and thank you so much for subscribing. Right, so we are going to be looking at the different types of trading or the different types of traders. We shall be looking at scalping, the trading, swing trading, and then the position trading. Okay, let's dive in. So we are starting off with scalping. That is option number one under the different types of trading. So under scalping, traders hold trades for a few minutes most, and their main objective is to grab very small amounts of pips as many times as they can throughout the busiest times of the day. Okay. So scalping is a trading style that specializes in profiting off small price changes and making fast profit off reselling. Okay. So scalping requires a trader to have a strict exit strategy because one large loss could eliminate the many small gains the trader worked to obtain. So having the right tools such as live feed, direct access to a broker, and stamina to place many trades is required for this strategy to be successful. A successful Forex scalper will have much higher ratio of winning trades versus losing ones, while keeping profits roughly equal and slightly bigger than the losses. So a pure scalper will make a number of trades each day, perhaps in hundreds, and then scalping major focuses on the minute 5 and then a minute 15 time frames. And if you go so high as a scalper, you could go to the H1 time frame to look there for analysis. Okay, so we are saying that, for example, you have, so for example, you are on a chart. Okay, this is a minute 5 chart. Okay, and then you see that the price is going to rise. So for example, you get this format. Okay, so what happens is that every time you get a retracement, the scalpers come in, but what they do is that they hold up and then pick up profits very quickly. They do not wait for this retracement again. So they wait for the retracement when they have already sold off. If they take profits before a retracement happens. They buy, take profits, retracement happens. Buy, take profits, retracement happens. Like that, like that. Okay. If it is a consolidation market, in most cases, and this we should be looking at it at how to trade consolidations. So in most cases, you'll find that the scalper is going to be a person enters at the dip to buy, goes up, sells, sells at the top, buys at the top, and at the bottom, sells at the top, buys at the bottom. So they don't wait for the market swings. Okay, that's what the scalper does. They hold trades for at most 5 minutes, 15 minutes. They collect small pips, but they have to make sure that they win much more than what they lose. And we've said right here that successful scalper will have much higher ratio of winning trades versus losing ones, while keeping profits roughly equal or slightly bigger than the losses. So we are saying that at least you have to make sure that your system is winning 70%. Okay, because when you get one big loss, it can wipe away all the profits and then you've worked for nothing. So you have to make sure that as a scalper you get a strategy which wins at least 70% of all the times. So and then when you enter trade, for example, you enter trade and then you are targeting 20 pips, you have to make sure that your stop loss is at least at most 10 pips. Okay, so that you make at least much more than what you risk. That is what a scalper does. So the people who carry out scalping are the ones who call as scalper traders. Okay. So we have the advantages and disadvantages of scalping. So those are the pros are the advantages, and then the cons are the disadvantages. So and the pros, scalping can be very profitable if executed wisely with a strict exit strategy. So we are saying that as a scalper, you have to be alert. Okay. So if you enter trade, okay, this is our chart, for example. You've made a buy order right here. As a scalper, you don't wait for this retracement. So the price goes up, reaches a certain level, and then you sell off. Okay, for example, you buy here, wait for the price, don't wait for the tip, and then you sell off. So the exit is supposed to be quick. it shouldn't be too slow and it shouldn't be too quick. So that's why you're saying that you have to use a strict exit strategy, or you can use an indicator as an exit indicator, but in this format it might not work. In most cases, if a scalper targets a stop loss of $2, they have to make sure that what they make is at least $5, so that when they make a winning and losing trades, okay, so their target is $5, okay. So for example, here you win and then here you lose. What happens is that you have 3 pips in, oh sorry, you have $3 in net, because you lost at 2 here and then here you made 5, so you have a net of 3. So they make sure that they target much more than their stop losses. So that's why you're saying that exit should be strict and precise, okay. So many opportunities to leverage small changes in the price of the stock. So we are saying that they have so many opportunities, because the changes within the stock market are always, for example, when you look at the daily time frame, it is going to move like this, okay, the daily time frame. But again, even within this range here of moving up, there is this format. It does not go straight at once, okay. And the same happens here. There is that small type of trend which happens within this big trend up, and this one might happen on the H1 time frame, okay. So, and still again within these small retracements on the H1 time frame, if we zoom in, they are going to be like this, okay. And still when you go back to the minute 5 or minute 15 time frame, it will still have also something small like this. So these market movements, or the pivot points within the market, they are much more many within the lower time frames, and that's what the scalper uses to leverage on the market. So they get so many trades. For example, in a day they can get over 50 trades within the entire market. So if you get 50 trades within the entire market and you make sure that you win 70%, of course you remain very, very profitable. So that's what happens with scalpers. So they have to make sure that in a day, or for example in the H1 time frame, that is how the market moves. But in this general rule of the market moving high, make this swing high, okay, before a retracement. Within this swing high again, there are other short trends which happens within that. So they make sure that they profit from those small within these small short trends which happen within the bigger trends, okay. So when you have a big trend, for example this one, there is always a short trend within it, okay. So that's why the scalpers use, they use these short trends which happen within the big trends. So they do not follow basic fundamentals. That's under the scalpers. So the scalpers do not focus on the general outlook of the country. For example, if they are going to trade the dollar, for example, the dollar JPY as a pair, if you're going to trade the JPY, you don't need to know how United States is doing economically. They don't care about news. In most cases, they don't care about the general news, which are going to affect the country for a longer time. They don't focus about things like elections. So they don't focus on the fundamentals. Okay, so what they do for them, they normally focus on price action and how their indicators work for them. Okay, so there is very little market risk involved. Okay, so what we're saying that there is very little market risk involved, that they do not get so much risk from the market. In case the market changes, for them the changes have already happened within their trading systems and they have already exited those trades. Okay, no direction strategy can be used if the market is going up or down. So we are saying that they do not follow a specific strategy for following a direction. Okay, so their strategy follows what they chase the price, in short. So scalpers are normally price chasers. They be there to chase the price. Where the price goes, that's where they go also. They do not follow a certain trend and then say, oh, now the latest dollar is going to be on the rise, so what we are going to do is going to buy. But in the format of it going high, of course, we say that there is still the swing lows, okay, within the swing lows, okay. So what they do is that they buy on the move up and then they also sell on this move down. They buy, move up, and then they keep selling on the move down. So for them, they do not care where the market's going. They just chase the price. That's a scalpers. And scalpers can easily be automated in the trading system that is being used. So that is now known to each and every one according to the current softwares we're using. you can place orders. We have stop losses of take profits, and they can be placed, and the system will be there to execute your trades automatically. So under the disadvantages, we have high transaction of costs for participant. Of course, high transaction of course occurs within what we call the bid ask spread. Okay, the bid ask spread. So the spread is what the broker gains, or the commissions that the brokers put on scalpers. They tend to go higher. Okay, so what happens generally is that the transaction cost increases because you can find that a scalper has entered almost 100 trades, and if you're losing at least let me say 5 cents on a trade, that is just an example, but you will not lose that. If you're losing 5 cents on a trade, so it means that that's going to be $50 a day in form of transaction costs, but that will not happen maybe if you put in very, very big orders. So there is a high transaction cost because you put so many trades, and you hold them for a short time. Okay, so the many that trades, of course, the higher the transaction cost. So it requires greater leverage to make a profit. So what we are saying is that you either put in a big lot size, okay, for you to make money on a lower time frame. You have to use a big lot size, and then a big lot size means that you're going to also increase your leverage. Okay, so instead of using a leverage of around 1 to 25, so that means that for every $1 you put in the market, the broker adds for you 25. You will find that you lose a leverage of around 1 to, let me say, 500. That for every dollar you put into the market, the broker is adding for you $500, and that is going to be a very huge, a very huge leverage. So of which this leverage is a double-edged sword. It can work on you or it can work for you. Okay. So it can be time-consuming strategy that requires high levels of concentration. So we are saying that if you're going to follow a chart of minute 5 to be a scalper, of course it requires you to sit in front of your screen all day. Then you follow up with what the trading strategy gives. Okay. But if you're trading weekly charts, of course it means that you have to check on your chart. That is once a week. So that one becomes time 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 saving compared to whereby you're trading minute 5 time frame. It means that after 5 minutes you're supposed to look onto the chart and see how prices have closed. Okay, so it needs to make a lot a lot of a lot of trades per day to see a profit. So we are saying that you need to make almost 100 trades in a day, okay, for you to see a profit, so that you make, because you're going to make series of losses and then series of profits. So the more the trades you put within a day, the more you're going to leverage on the losses you make. And then you cut your edge of winning, it will also increase. Okay. So from scalping, there is what we call day trading. And then people who carry out day trading are the ones we call the day traders. So day trading equals the traders. Then scalping equals scalpers. Okay. So day trading means buying and selling a batch of securities within a day, as simple as that, or even within seconds. It is still under the day. So as long as a trade is covered, your trades are always covered within a day, you become a day trader. It has nothing to do with investing in traditional sense. It is exploiting the inevitable up and down price movements that occur during a day, during a trading session. So with a trading session, of course, we say the pairs will move in that format. Okay. So what you do as a day trader is that you target buying points, and then maybe you also target selling points. So that is what the trading is about. So you target those inevitable up and down movements of the market within a given day. Okay. So tips to start the trading, of course, make sure you come in with some knowledge. That is a must. Always invest in knowledge, and a good idea of your risk tolerance, capital, and then goals. So for example, you can say that my target is to make $10 per month. Becomes achievable. So how much capital do I need? And then you say, maybe I need $1,000. So if you need $1,000 to make $50, that is 5% a month. And that is very achievable goal. Okay. And then you also need to mind your risk tolerance. For example, you know that a person who cannot bear a lot of to see losses of course, you know that I'm going to use a given specific stop loss, for example, the one we use on this channel. Okay. So you have to be prepared to put in time and practice to perfect your strategies. That is for straightforward. You have to start small, whether you want or not. I don't recommend you to wake up one day without a knowledge of forex trading and then you come and put in um, and then you put in 10 grand or $10,000. So I can expect you to start with a small accounts of around $1,000, $500, like that, so that you can gain experience. Or you start with a demo trade, demo trading. So going all out will complicate your trading strategy and can mean big losses. So you stay cool and try to keep emotions of your trade and then don't deviate from your plan. Don't forget that you want to make 5% a month, for example. That was your target. And then the traders majorly focus on the minute 15 H1 and then the H4 time frame because these ones are covered within a day. So we're saying that you can focus on the minute 15. Below minute 15, you become a scalper because you're going to hold trades for minutes. Okay. So minute 15, you can hold a trade for almost 3 hours or two. And then you have the H1 time frame and then you have the H4. And then the other thing to notice that um, the lower the time frame, the more you need to be on the chart. Okay. So we are still on the trading. Okay. Or the day traders. So we have the risks of the trading. Okay. You have to be prepared to suffer severe financial losses. You don't expect that you're going to make 10 winning trades. But out of the 10 trades, we agree that you can make 7 win. And then you can make a 3 of loss. And then you have a net of 5 on your account added. Okay. But sometimes you can make 6 loss and then you make 4 win. Okay, that is how the trading is. There is a series of winning and losing. Okay. So the traders typically suffer severe financial losses in their first month of trading, and many never make a profit. That one you have to keep it in mind and solid. Okay. So many never make a profit in the trading, but with specific entry and exit rules that we shall be looking at on this channel, you will not be under that. Okay. So the trading is extremely stressful as a full-time job. Okay. So watching dozens of ticker codes and price fluctuations to stop fleeting market trends demands great concentration. So we are saying still, if you're trading on the H1 time frame, it means that after 1 hour you're supposed to look onto the chart, and that is time consuming. So if you're a person who is employed somewhere, of course you're going to get difficult with your bosses. So the traders depend heavily on borrowing money. So it means that you have to leverage. You have to use borrowed money in order to execute your trades because it requires a lot of money. Trading requires a lot of money, and that money you do not have it, but the brokers are willing to borrow you some money. Okay, so the trading strategies using leverage of borrowed money and make profits. Many the traders not only lose all of their own money, they will wind up in debt. Okay, that is what you shouldn't forget, and then you be cautious. So don't believe claims of easy profits; they never exist. There is no free lunch in the world. Whether you want or not, there is no free lunch in the world. So watch out for hot tips and expert advice from newsletters and websites catering for day traders. And remember that educational seminars and classes about the trading may not be objective. All right. So we are moving on to our next format of trading. That is what we call the swing trading, or we are looking at these people called the swing traders. So here, traders hold onto trades for several days or several weeks at a time. So this type of traders can't monitor their charts throughout the day. So they dedicate a couple of hours analyzing the market every night and make sound trading decisions. Okay, those are the swing traders. So swing trading involves taking trades that last a couple of days or up to several months in order to profit from the anticipated price move. So what we're saying that if you're a swing trader, you have to focus on higher time frames, in short. Okay. Swing trading exposes a trader to overnight and weekend risk over the price, where the price could gap and often the following session at a substantially different price. Okay. So we are saying that in swing trading, a swing trader, since you hold trades overnight, it means that when you wake up tomorrow, it means that the market would have changed, how the sentiment looks. The general outlook of the market would have changed. For example, today the dollar would have been strong and it is on a move high. Okay, but within the night when you're asleep, something happens and the dollar weakens and then find it down all that time. So you get exposed to that risk, okay, in swing trading. So yes, it is rare, but it might happen also. It is very possible. So, and then other thing is that sometimes you see that the market is moving high and high, and then the other time it creates a gap and then it opens around here. So this is also another risk which can put your stop loss out, and then maybe the market still continues in the direction where you wanted it after creating this gap which has put out your stop loss. So you also have to watch out for that. So swing traders can take profits utilizing an established risk reward ratio based on a stop loss and profit target. They can take profits or losses based on technical indicators or price action movements. That's normal. So swing traders major focus on H4 and then the daily time frames, or sometimes the weekly time frames. Okay, that's under swing trading. But swing traders majorly focus on H4 and then the daily time frame, TFS time frame. Okay. So we have the pros and cons of swing trading. So we are going to start with the pros or the advantages. It requires less time to trade and the trading. Okay. So for example, if you are trading the daily candles, it means that you have to be on charts only once a day. So that becomes very comfortable compared to day trading where you're trading H1 and you have to be on charts. That is every after 1 hour. Those are 24 hours a day. Or those are 24 times a day. Okay. And in day trading, of course, you'll be on the charts once a day. Okay. So it maximizes short-term profit potential by capturing a bulk of market swings. Okay. So we are saying that if, for example, the dollar has taken a full month being on an up, that is one full month. Okay. That's a dollar on a clear uptrend for 1 month. Within the daily chart, you can see movements of this format. Okay. For it to reach here. This is in 1 month, okay? But when you go to the H4 time frame, of course, you're going to find something like this. Something like this. So you can find something of some sort of a bear market in the H4 time frame. But when you go to the lower time frame, like minute 15, you'll find that this bear market lasted for a long period, and then this retracement also lasted for a long period, and then you get a bull run once again to go back to that same level. So when swing trading, you get rid of such market swings which happen in lower time frames, and then you capture this big move once. Okay, so traders can rely exclusively on technical analysis and simplifying the trading process. So in swing trading, yes, you can focus on technical analysis only, but still also recommend the fundamental analysis. So under the disadvantages, trade position is subject to overnight and weekend market risks. We are saying that, for example, if you take a trade on Monday day, okay, and then hold it for like the next 5 days up to Friday, and then you go for weekend. This is where you stopped on Friday. So by the time we come out of the weekend for the market to reopen, you might find that the market sentiment has changed, and then on Monday the market opens, and then the following week is a bear market, yet you expected a bull market. So that is why you are saying that you get subjected to overnight and swing and weekend market risks simply because you hold trades overnight and then during the weekend. So abrupt market reversals can result in substantial losses. So in the daily time frame, though it is not so common, we're saying that, for example, you're in a clear uptrend and then you're holding it for a longer time, and then you can get bad news within the country and then the market collapses once again. So swing traders often miss longer term trends in favor of short term market moves. So we are saying that, for example, if on the entire year the market's going to move like that, say still in the month it will be like this, but in the day it might be like this. Okay. So maybe we can see this on a chart later on. So we're saying that you can find that in a day you've not traded here, then you've not traded here because you're a swing trader. And on a monthly chart, you've traded everything and taken all the profit. Okay. So we want to put a comparison between day trading and swing trading because this normally happens all the time. Okay. So we said under this day trading, traders are going to focus on minute 5. traders will also focus on minute 15, and then traders will also focus on the H1 time frame. Traders will also focus on the H4 time frame. That is under the trading. And then on swing traders, traders are going to focus on the H4 time frame. And then they'll also focus on the daily candles. So what happens, the basic difference is that here the swing traders, they don't focus on minute 1, minute 5, and then H1 in most cases. And then the traders focus on from minute 5, 15, H1, what. So minute 5 is rare, okay, just from 15, H1, and then H4. So you can see that they seem to look the same because they can hold, they can hold trades, but they do not put them overnight as a day traders. So the trading, they make multiple trades per day. That is one thing you have to make sure of. That as a day trader, you might put in around 10 trades a day. But as a swing trader, you can put in like 5 trades a week. So you're saying they make several trades per week. So this one puts in 10 trades a day. For example, that could sum to 50 trades a week. But when the swing traders put in 5 trades within that same week. So this one is more cumbersome in terms of putting orders, okay? So positions last for hours to days, and then here positions last from days to weeks. So positions lasting for hours might be good or it might be wrong because one, you do not capture the entire market, and then number two, it is stressful to be on the charts all the time, and then yeah, the vice versa becomes good. Okay. So here it becomes a full-time job if you want to become a day trader like H1 time frame. You cannot focus on your employer's job at the same time and then you're focusing on the charts. You will lose the focus. But here swing trading becomes part-time. You can do other things and then you leave Forex as a part-time job, okay? They use short-term signal to buy and sell. Okay, here they use long-term signals to buy and sell. So because you hold for days, for only a single day, so within that same day, and here you hold for days, that's why you look for longer term signals. So it relies on the start of the art of trading platforms and tools, and yet can be accomplished with a standard brokerage account. So this is not so necessary because they all use brokers. So it means that you can go to the broker direct or you can use a trading platform. Here they suffer multiple smaller gains and losses. Okay, so you can have, for example, 50 losses, which are small. But here you can have 4 losses, which are equivalent to this 50. So this one looks to be easy to manage compared to the 50 losses. Okay, here you put fewer and substantial gains. Sorry, they get fewer and substantial gains, losses. That's a basic difference between the traders and swing traders. So the last type of trading is called position trading. So position traders are those that have trades that last for weeks, months, and even years. Okay. So these traders know that the fundamental themes will be the predominant factor when analyzing the markets and therefore make their trading decisions based on them. Okay. So position traders, they normally focus on making trades which last for weeks, which last for months, and those ones which last for maybe a year. Okay. So for example, they know that the general market outlook of the United States dollar is going to be bullish the entire year. They just buy and rest. They never look on charts once again. They just look on the charts maybe after a week or a month just to monitor their trades in case anything changes. Okay. So a position trader buys an investment for a longer term, okay, in expectation that it will appreciate in value. So this type of trader is less concerned with short-term fluctuations in price and news of that day, unless they alter the trade's long view of the position. So we are saying that if the general movement of, for example, the United States dollar is going to be this one within 1 year, you will find that this is on the yearly chart. You'll find that within the monthly chart, it's going to be like this, a beautiful clear uptrend. Okay. And then you'll find that within the daily charts, this retracement here on the daily time frame, Oh, sorry, this is the monthly. So, for example, here weekly, you can find that it is going to be this format like that. And then you can find that on the daily time frame, it is going to have a more big something like that. Then it reaches the same, and then it reaches the same level. So when we do not focus on these fluctuations with as position traders, so we normally focus on the bigger outlook, unless if this changes our general outlook of the entire market within that given time that we forecasted. Okay. So position traders might be seen as opposite of the traders. Okay, they do not trade actively, with most placing fewer than 10 trades a year. So for example, in a year you can make around 8 trades, and then out of the 8 trades, maybe you win 7 and lose 1. So you become very, very comfortable with that. Okay. So position traders may use technical analysis, fundamental analysis, or a combination of both to make their trading decisions. Okay. They also rely on macroeconomics. Macro means the large view of the economy factors. They look at the general market trends and then historical price patterns to select investments which they believe are about to go higher. Okay. So it's the best way to trade in most cases. That's the truth. Whether we want or not, it's the best way to trade. And position traders focus major on the daily, weekly, and then the monthly time frame. Then we have the yearly time frame also works. Okay. So this is the best way to trade, or swing trading is also somehow better. So the higher the time frame, the better it becomes. Okay. So that has been it. And then we have concluded. In conclusion, we have the swing traders, we have scalpers, we have the traders, and we have position traders. So you can choose who you want to be. Okay, but I would recommend swing trading or position trading. So if you have a very limited capital you want and you have enough time, you can go for scalping or you can go for bit trading. So thank you so much for watching this channel. Uh, and thank you so much for watching this video. And thank you so much for staying on this channel. My name is Wisdom Jordan. I'll see you in the next video. Bye bye.